Hello, everyone. Welcome back to Current Economy and Investment Insights. I'm Ron Jankowski with Channel 4. My co-host Paul Munichol is at his studio to keep our distance. Today is April 5th, 2021. I'm going to let Paul take it away and give us an update of what took place last week in the marketplace. Take it away, Paul.
Thanks, Ron. I want to start out today's show with a bit of good news, and it has to do with the economy. And today we're going to talk about from strong to stronger. The economic surge has begun. The markets were closed on Friday for Good Friday as the Labor Department released its economic report for the month of March. Many people may have also been away from the office in the holiday shortened week for vacation or maybe their kids' spring break. The economic data you may have missed on Friday was more than just a strong jobs report. And here are some of the few highlights. The Labor Department said that 916,000 net new jobs were created in March. It also said 156,000 more jobs were created in January and February than previously measured, bringing the total increase in employment reflected in the report to more than 1 million. Also, the Institute of Supply Management's Manufacturing Index for March came in at a reading of 64.7. It was the manufacturing index's highest reading for more than 37 years. In addition to that, the production component of the ISM index jumped to its highest level since 2004. It also came despite materially lower production volumes in the auto industry on account of the global chip shortage. Speaking of auto sales, unexpectedly surged to an annualized sales pace of 17.7 million in March. According to the BEA, it was the strongest level of auto sales since October 2017 and was generated despite dwindling dealer inventories. If that's not enough, we hiked our 2021 full-year real GDP estimate to positive 6.5% from a prior 5.5%. Lots and lots of good news came out of that report on Friday. The much stronger than anticipated 916,000 net new jobs created in March also came despite a weaker than expected gain in the leisure and hospitality sector. Leisure and hospitality businesses still added a very strong 280,000 jobs in March after a gain of 384,000 in February. But given that the singular sector accounted for 43% of private sector jobs still missing since the pandemic set in, we expect it to accelerate from its February gains. Nevertheless, it's a clear positive that hiring in March was so broad-based. The measured pace of rehiring in the L&H sector, however, may be a bit worrisome if it reflects hiring difficulties in the space. Businesses in many, if not most, areas of the country have reported significant challenges in restaffing. That's a problem that could show economic activity over the near term modestly, but more importantly, in our view, add to inflation pressures down the road. All in all, it's a great start to the next quarter of the year, and the good news was well received. We just need to keep progressing with our COVID vaccines and people avoiding the virus, and we are hoping to have another positive report for you the start of the next quarter. Thanks, Ron. I'll send it back over to you.
Thanks, Paul, for your update. And Ameriprise had also shared with us this morning's news. The U.S. stock index futures are higher in reaction to Friday's better than expected March employment report. The yield on the 10-year Treasury is holding near 1.7% after the U.S. unemployment rate fell to 6% last month. The global equities are mixed and relatively light trading as most exchanges remain closed for the market holidays. And the last is the shares of Tesla are higher in early trading after the company reported nearly 185,000 vehicle deliveries in first quarter of 2021. The year-to-date positive returns are as follows. The S&P 500 is up 7%. Dow Jones, again, is at plus 8%. And the NASDAQ is a plus 4%. And that's it for the current economy. And what we're going to talk about is your money. We'll be right back. Stay with us. And Paul usually has a very interesting topic. Stay with us. We will see you in a little bit. And we're back with your money. Thank you for staying with us. And I'm going to let Paul take it away with his current topic.
Okay, today I want to talk to all the mortgage holders out there on the homes they're in. And I've got the eternal question for you. Should you pay your home mortgage off early? Let's dive into the data a little bit. Many people who carry a home mortgage dream of the day when they will no longer face the burden of a monthly house bill. They want the financial freedom and the satisfaction of owning their home outright. But does that mean you should be paying off your mortgage as an early priority? The answer depends on your circumstances and goals. One question you should ask yourself is, would the money you spend on your home loan be better spent on or invested in another financial opportunity? So let's get a different perspective on debt. Reducing debt as early as possible could help you avoid costly interest rate charges. You may have experience with this principle if you've eliminated credit card debt or a car loan. Now, while your home mortgage is a type of debt, the same concept may not apply. In certain instances, staying true to your repayment terms may be the best for your financial situation for a couple of reasons. One, interest rates on mortgages tend to be more reasonable than other types of credit, and the terms often provide more certainty, so 30 years, for example. Second point is the interest you pay can potentially be deducted from your taxes. Now, this deduction makes a mortgage much more efficient on an after-tax basis than most other forms of debt. If mortgage interest is part of your tax strategy, consider if you'll be able to itemize deductions once you own your home outright. Now, on the other hand, the earlier you pay off your loan, the longer you could have the opportunity to invest the money each month. This additional investment could help you achieve a more secure financial future. To see if investing may make sense, compare your interest rate to what you could reasonably expect to earn in market returns. You also have to factor in time. As you evaluate your situation, you should consider the time you expect to stay in your home and how close you are to retirement. Those who are approaching retirement or are already retired may prefer to be done with the monthly expense of the mortgage, since this is also a stage in life when your investment approach may be more conservative. The trade-off of reducing your balance rather than investing may not be as significant. Those who are in this position may want to consider if accelerating payments today would help reduce housing expenses in retirement. The same is true for those of you who plan to stay in their homes for a long time. Reducing your loan may be appealing if it results in years of living without a house bill. Younger homeowners should explore methods of accelerating their mortgage pay down. Among the strategies to consider are contributing a little bit more each month, refinancing your mortgage over a shorter term, for example, turning a 30-year into a 15-year mortgage, or occasionally making a larger lump sum payment to reduce the balance. Finally, let's talk about the emotional side. Deciding if you should carry a home mortgage is not only a rational decision, but an emotional one as well. Your home is where you raise your family, create memories, and return to each day. How important is it for you to know that you own your own home free and clear? As you think about your decision, be sure you're in a position to not jeopardize your financial security today by putting additional funds towards your home. Adjusting your monthly bill will impact your cash flow, and you'll want to have flexibility in your budget to cover unexpected expenses. Always review your financial circumstances carefully before you decide what's right for you. And on that note, if you need help with a financial advisor working with these types of situations or working with your investments, feel free to give me a call directly. I am here to help you. You can reach me at 708-226-3412. That's going to do it for me, Ron, for this week, and I will be back next week with a new topic for the viewers at home. Have a great week.
And thank you, Paul, for that interesting topic. And for Paul Munical with Ameriprise Financial, myself, Ron Jankowski with Channel 4 in Palos Heights, we wish you good investment day.